Hello, my name is Magnus Petersen, and this is another video on investment finance in my tremendously popular series. In fact, I just got an email from YouTube where they were complaining about these videos having so much traffic that they are overloading their YouTube servers. No, seriously, the videos I'm making here are not easy to make. They take quite a long time to make because they are so polished and the ideas are actually quite original. The reason I'm spending so much time on making them is that I believe they are very important. What I have shown you in the past two videos and in this one as well is not being taught at even the best universities in the world, and it is something that I believe can help stabilize the financial markets. So that is my hope for the future, that eventually over the next, let's say, 5 to 10 years, that these videos will gradually become a part of the curriculum of a lot of universities in the world so that people understand these techniques so they can use them to better understand the markets and allocate their portfolios. And that is what we're going to talk about now. So we are interested in combining multiple stocks or other assets into a single investment portfolio. We only consider stocks and stock indices in this video here. And of course, the naive way of doing that is to have equal weights for all of the stocks. But we can also try and do it more intelligently so that we maximize some performance measure, and this is called portfolio optimization. The only method that they teach you in academia is called Markowitz portfolio theory or mean variance portfolio optimization, because it tries to maximize the portfolio's mean return while minimizing its variance. But there are several problems with this method. Actually, if you read Markowitz's book, he didn't really know how to forecast the return distributions. So the basic way that this is being used is to use historical data. So we use the historical returns and their covariances, and we just somehow assume that these will be valid for the future as well. What we really need is a way to use predictive signals to adjust the future return distributions. The second problem, which is perhaps even more important, is that Markowitz portfolio optimization uses the variance of the return distribution as a risk measure that must be minimized. But this is a fundamental misunderstanding of finance, statistics, and even the English language, because the variance measures the spread of the distribution, but that is not the risk, because if you look up the definition of the word risk in a dictionary and how every normal person understands risk, it is the chance of injury or loss, and that is not measured by the variance. The variance measures the spread. I have already made 2 YouTube videos explaining this in more detail, so you can click on the links here and here to see those videos. I'm not going to go into that again. But there's this funny cartoon here, which actually nails it right on the head, what the problem is with Markowitz portfolio optimization. And I remember even reading a paper written by Markowitz a few years after the financial crisis and the stock market crash in 2009. And Markowitz essentially argued for diversification. But his formulas, his method for doing that are fundamentally flawed because he uses the variance as a risk measure. Okay? So the cartoon says you should invest all of your money in diseased livestock. It would be unwise to invest it in just one sick cow, but if you aggregate a bunch of them together, the risk goes away. It's called math. And Markowitz actually won a Nobel Prize for that crappy theory that he made, which is basically just a form of multi-objective optimization. But again, variance does not measure risk. Get it through your head. Now, the method I'm gonna show you in this talk here is experimental. I cannot test it properly because I don't have enough financial data. We have enough evidence to suggest that the method is sound, that it could work in practice, but it probably needs more research to do that. And I gotta say something that I need to get off my chest, because I get fairly regular inquiries if I want to work for people. Unfortunately, most of those are not very serious, and it gets on my nerves. You're not gonna find any professor on the entire planet that has the cross-section of skills that I have. You're not gonna find anybody in Google that has the cross-section of skills that I have. You might find somebody in a hedge fund somewhere, but if you could find that person, he's not gonna work for you for peanuts and bananas like he's a trained monkey. So if you want me to work for you, it might be possible, maybe, but step to me correctly and respectfully. Not like you pay me $100 and I work for you for 3 months. Fuck you. Okay, so let's get back to business. Now, you really should have seen the first video in this series before you watched this video here. It is about forecasting long-term stock returns using the price-to-sales ratio for the S&P 500 and some individual stocks. And what we had were these scatter plots here, where we would have the price-to-sales ratio of the S&P 500. And this is not for individual companies. This confused some people. This is for the entire S&P 500 index in aggregate. So we have the price-to-sales ratio here on the x-axis, and we have the annualized return over the following 10 years. And what we saw was a relationship quite clear and quite strong that we could use the price-to-sales ratio as a predictor for the annualized return over the next 10 years. And this was for the S&P 500, and this was for a company called Johnson & Johnson. And again, we see a very clear relationship here. So the question is, how do we combine the S&P 500 and Johnson & Johnson when we know the price-to-sales ratio of each of those, and we can use that to estimate the future returns over long periods like 5-10 years, something like that? And how do we make a general method for allocating our portfolio when we have a bunch of stocks with some predictive signals? That is what we want to do in this video here. So let's go back and look at the flowchart. So what we're going to do first is we're going to split our data set into a training set and a test set. Then we take the predictive signals, such as the price-to-sales ratio for each of the stocks, for the training set. We want to input this into some mathematical model for the portfolio allocation, and we want to have some parameters for this model that we will find through optimization. This produces stock weights that we can combine with the stock returns for the training set into the cumulative portfolio value. So if we do this weighted rebalancing of the portfolio, for example, every day, then what is the portfolio value after 1 day, 2 day, 3 day, and so on and so forth, up to the entire length of the training set. So this might be 10 or 15 years or so worth of data. Then we calculate some fitness measure to find out how well does the portfolio allocation model perform using these model parameters. Then we send this fitness measure back up to the optimizer, and it will try and find some new model parameters to try, and we repeat this cycle here until we have found model parameters that are sufficiently good on the training set. We will use 3 different portfolio models in this video here. The first one is the naive equal-weighted portfolio, which does not require any optimization because the stock weights are just equal, so the portfolio is rebalanced equally every single day. The second type of portfolio model is called the fixed weight model, where the portfolio weights are the same throughout the whole period, but they may not be equal, and the way we find them is through the optimization loop that I showed you above. The last portfolio model we will be using here is called adaptive weights, because the weights will change every day according to the signals for the stocks. And the mapping from the signals to the stock weights is some mathematical function where we find the parameters through the optimization loop that we showed above. This method might be called a direct form of portfolio allocation because we are mapping directly from the predictive signals to the stock weights. An indirect method of portfolio allocation would first have to estimate the return distributions for the stocks and then use those distributions to find the optimal portfolio allocations. The advantage of using a direct method is that it avoids the complexity of having to model the return distributions, which is likely also going to produce significant estimation errors. And it also avoids a complicated optimization problem, which we would have to solve every single time we want to rebalance the portfolio. Instead, our direct way of doing the portfolio allocation simply maps the predictive signals to stock weights in a manner that has been found to work well on the training data. Whether that also works well on the test data, that's a different matter that we will get back to. The fitness function measures how well the portfolio model performs with the given parameters on the training set. And this is used to guide the optimization procedure to find better parameters for the portfolio model. And we could define this fitness measure in a million different ways, and it is done in this function here, portfolio.model._fitness. I won't show you how any of this code works because it's actually fairly simple and it's quite well documented. And again, this is something that actually takes time to make. When you see my code, it looks so simple that you think, oh, this is something I could do in 5 minutes. No, my code looks like crap just as anybody else's when I'm working on it. it looks good and it's beautiful when I polish it and I go through it, and that can take a long time to do. So anyway, hopefully you can understand the code by just reading it, and I will just explain the big ideas in this video talk here. The main fitness measure is the mean log return for all 5-year investment periods, and this is also known as the Kelly Criterion. And there's a brilliant book about Ed Thorpe, who was a mathematics professor who made the first real hedge fund. And he was a brilliant man. I think he's still alive, but he's really old now. And the book is called, I think it's called Fortune's Formula. And it's actually really, really exciting if you like computer science and math and finance and things like that. It's really exciting. But anyway, he was using the Kelly Criterion to allocate his portfolios. So we use a combination of that, and then as an example of how you can penalize the main fitness measure, if more than 7% of all 1-year investment periods had losses, then we severely penalize the fitness measure. This means that we strongly prefer portfolio models and parameters for those models with few 1-year losses, but this possibly comes at a cost of lower long-term returns. Oops, I made a mistake here. And I would encourage you to experiment with this fitness measure because you can maybe shape the return distribution in some interesting ways. Okay, so once again, I'm not going to go through the implementation, but we just have usual Python imports from Python packages and from this finance ops library that I have made. And then we load the data for the stock indices. Well, first we define the ticker symbols for the stock indices and for the stocks. And there's actually data for 2 more stocks, GPC and Walmart. And I had to manually collect all of this data from the annual reports of these companies. And this took several hours for each company. And I actually know how to read those financial statements. Find a finance professor who actually can do that. Those are rare. Find a computer scientist who can do that. Those are almost non-existent. I just saw a talk from PyCon, I think it was this year or last year, and there was a lady who was talking about how to code like an accountant or something like that. And I got to the point in the talk where she said that assets equals liability plus revenue. And I thought, what the... And then I stopped watching the video because that lady knew nothing what she was talking about. So anyway, let's continue. And then we actually load this data into pandas data frames. We load it for the stock indices up here, and we load it for the stocks here. So the total number of assets that we will consider is 12, and this is fairly small. And I will get back to this discussion further below, but I think you should probably have at least 100 stocks for this to work. Okay, so let's talk a little about the predictive signals, and let's go back to the notebook for the first talk again. So what you want to do is you want to make an analysis like this when you have a new stock you consider, and you have a signal such as price to sales. You need to make sure that there is some kind of causal relationship between your predictive signal and the return of the stock. If there is no such relationship, then do not use that signal because the optimization method is stupid. It cannot realize that this data is unrelated. So it might figure out that some weird coincidence in the data leads to higher returns on the training set. But that is not going to continue in the future on the test set or in the future in general. So you need to make an analysis like we did in the first video to ensure that there is a relationship between your signal and the return on the stock. Another thing you should be careful with is that your mathematical model only maps signals to the correct stocks. If you use, for example, a fully connected neural network, it will take all the signals for all the stocks and use them to allocate the stock weights for all of the stocks simultaneously. And again, there might be a coincidence in the training set. The optimization method might find that, oh, if the price to sales ratio for Coca-Cola is like this and for Kellogg's it's like this, then it improves the return for Johnson & Johnson. Bullshit. It has to be related. So you have to be careful when you make your mathematical model that it only maps predictive signals correctly to the relevant stocks. Now I made it very simple in this code here because we only use one predictive signal for each stock. So for the S&P 500, we use a price to sales ratio, but for the S&P 400 and 600, I don't have the sales data. So instead we use the dividend yield, and you should try and go through the first notebook that I just showed you over here and do this analysis for the S&P 400 using the dividend yield as the predictor signal, and do it for the S&P 600 as well to try and find out if there really is a relationship between that signal and the return on those stock indices. So anyway, for the individual stocks, we do have the sales data because I have manually collected that from all of the annual reports. So we can use a price to sales ratio as a predictive signal for those stocks. And then we combine all of those signals into a single pandas data frame so that we can remove the rows with missing data. And we can show the data. It looks like this. So this would be the price to sales ratio for the S&P 500, the dividend yield for the S&P 400 and the 600. And this is the price to sales ratio for the first stock, which I think is the one with ticker CLX. And another thing I want to mention right here is that I got this question a few times about survivorship bias. These stocks were selected carefully. I started with the entire universe of stocks. Then I found companies that had existed for a very, very long time. Then I took the companies that had some kind of business that was qualitatively predictive. Kellogg's, they make cornflakes. They're probably gonna make the same 50 or 100 years from now. That is easy to predict. And if the business is well run, it's probably fairly stable in terms of economics as well. And this is another thing when people don't understand finance and they take, oh, we have 5,000 stocks in our database and we're gonna try this portfolio optimization model that Magnus has proposed and we're gonna take it on price to sales or price to book ratio on all of the stocks. Don't do that. You have to go through the analysis that I just showed you to make sure that there is some kind of predictive relationship between the price to sales ratio and the returns on the stock. Even so, that may not continue in the future. So anyway, now that we have all of this data in a big pandas data frame, we need to pull that out as a NumPy array, and then we scale it because the values can vary quite dramatically, and especially if you have many other types of signals as well. So that now the signals are between 0 and 1. What we are going to do for simplicity here is that we're going to use the daily returns, so they are interpolated from the data that we have. So we will calculate the value of the portfolio and rebalance it on weekends and holidays as well. In real production code, you probably shouldn't do that because it might introduce some distortions to the portfolio model, but we do it here because it's easier. So first we calculate the daily returns and we get a two-dimensional NumPy array out of that. And of course, the idea is that we generate a 2D NumPy array with stock weights so that we just multiply them together. Now we will only consider so-called long investing, so that is we buy a stock and then we sell it at a later date. We don't consider short selling, and this is one topic out of many that you could research. So we will just have the minimum weight for a stock to be 0 and the maximum to be 1. However, we will only allow the stock weight to be 1 for the stock indices, and for the individual stocks, we only allow it to be 0.2, so that an individual stock may at maximum occupy 20% of the portfolio at any given time. And this is one attempt to regularize the portfolio model so it doesn't overfit too much on the training data. Ideally, you would have a much larger number of stocks to choose from so that the maximum stock weight would only be 5% or maybe even only 3%. But when we have only like 9 stocks as we have here, if we only allow very small portions of the portfolio to be allocated to each stock, then most of the portfolio would most of the time be allocated to an index. And so we would basically just be tracking the index. Okay, so we have to split our data set into training and test sets, and I just split it in half. And I encourage you to experiment with different splits because it will behave differently. And let's go back to the first video that I did on forecasting long-term returns. So imagine, for example, that we split our data set so that only these points up here are in our training data. So our portfolio model will only see price to sales ratios in this range here and with these annualized returns here during the training. So this is probably not going to generalize very well to price to sales ratios that are up here and where the annualized returns are much lower. And this is, of course, one bad thing about using very long-term predictive signals, that we need quite a long period of data to train them on. So anyway, let's go back, and we just have some additional code here for splitting the data set into training and test sets. So we split the daily returns and the signals, and for convenience, we also split the dates so that it is easier for us to plot for the training and test sets. Okay, so here we have the portfolio model with equal weights. And this is very simple. It just has the same weight for all of the stocks. And in this case, we have a 0 weight for the cash, but you can change this boolean up here to true, and then you have an equal weight for the cash as well. So here we have the portfolio model with fixed weights. So remember that these are actually optimized, but the same weight is used for every single day that we rebalance the portfolio. And this is very fast to train. It takes only about 5 seconds. And the weights we get out of this is about 21% allocated to the S&P 400, about 6% for CLX, about 13% to DE, and about 18% to GIS, and so on and so forth. And these sum to 100, but they could also sum to less, and then some of the portfolio would be allocated to cash every single day. But the optimization method has found that there was no advantage to having anything allocated to cash for the training set. Okay, so now we get to the more advanced portfolio model using adaptive weights. So this takes in the predictive signals for each of the stocks and maps them to stock weights. And the mathematical function for doing that is actually just very simple. It's a linear function. So we have, for example, for the stock CLX, we want to determine its weight, and we have its signal here. And I could have added a subscript for the time step t as well, but we just keep the notation a little simple here. So we have the signal for each day, and then we have a parameter that we want to determine, a, that we multiply with the signal, and then we add another parameter b, and we have these parameters a and b for each of the stocks in our portfolio. Then we have a sigmoid function to smoothly limit this between 0 and 1, instead of using a hard limit that would just clip it. So when we run this code here, sometimes it takes a few seconds, sometimes it takes 2 minutes. But it essentially just runs the optimization loop that I described above in the flowchart, and it tries to find all of the parameters A and B for all of the stocks simultaneously. And this is another topic of research that you could investigate, because it might be a lot better if you first find the weights for each stock individually, and then you finalize it by multiplying with another parameter C, which you optimize simultaneously for all stocks. This might avoid falling into local optima. I don't know, I haven't tried it. You can try it and let us know if it works. So anyway, these are just showing the linear formulas with the parameters that we just found. For the S&P 500, the weight is minus 1.54 multiplied by the signal minus 9.41. And then you have to wrap this in the sigmoid, and you have to do some other scaling and limiting to ensure that the portfolio weights sum to 1 at most. But this just shows you the raw parameters for the formulas that we found in the optimization. We can also plot these adaptive weights for the training set and the test set, and we need a little helper function for that, and I'm not going to explain what it does because it's all beautifully commented. And the reason that I include these functions in the notebook itself is that you can then very easily modify it if you want the plots to look differently. So when we run this function on the training set, we get this plot here. And it shows several different things. The first thing to note is that on the y-axis, we have the scale of the stock weight. So for the stock indices, we allow the weights to go up to 1.0, which is 100% of the portfolio allocated to each of those stock indices. But as you see down here, for the individual stocks, we only allow a max weight of 0.2, or 20% of the portfolio being allocated to any single stock. And the solid black fills here show the stock weight on this scale on the y-axis here. So for the S&P 500, which is up here, we can't quite see the label here, but this is for the S&P 500. It has roughly 0% of the portfolio allocated to the S&P 500 for any given day in the training set. For the S&P 400, we have about half of the portfolio allocated to that stock index for this entire period here. And let's scroll down and see what the dates are. So this is between the years 1995 and 1997. And then let me explain what the red lines are. These are the signals for those individual stock indices or stocks. So for the S&P 500, this was the price to sales ratio, which means that as the ratio goes up, the stock is more expensive. And I should also mention that for the signal, the scale on the y-axis is always between 0 and 1, because you should remember that we scale the signals to be in that range above. So to use the full range of our plot, we always show that scale here. So what we see here for the CLX stock is that as the price to sales ratio goes up, so the stock is more expensive, the stock weight goes down. And you see it even follows these little oscillations here quite closely until finally the signal is all the way up and then the stock weight is all the way down. And this is the type of behavior that we want to see, provided that this signal is a good predictor for the future returns of that stock. And what the portfolio model has found, or the optimization of that model has found, is that there was never really any advantage to having any part of the portfolio allocated to the S&P 500 or the S&P 600. But sometimes it was a good idea to have a significant part of the portfolio allocated to the S&P 400. Okay, so let's look at some of the other stocks. Here we have the ticker CPB, and if I remember correctly, this is Campbell Soup, which is one of those other companies like Kellogg's that makes food. So this is something that is probably gonna make the same type of products 50 years into the future as it does now. So it has some qualitative aspects that are easy to predict. And that is why it might be easy to trust the relationship between its price to sales ratio and its future returns. But the portfolio model found through the optimization that there was no advantage to ever allocating any part of the portfolio to CPB. But if we only allowed, say, 5% of the portfolio to be allocated to any individual stock, then maybe the portfolio model would have found that it would be a good idea to sometimes allocate a part of the portfolio to this particular stock. So here we have another stock, DE, which I believe is Deere, which manufactures like farming equipment and tractors and things like that. And again, we're always going to need this type of equipment. So this is a company that is probably going to exist 100 years from now if it is well run, well managed. So once again, we see a relationship between the predictive signal, the red line, and the stock weight, which is the black fill. When the signal goes up, the stock weight goes down, and vice versa. When the signal goes down, the stock weight goes up. This is exactly what we want to see. And here we have it for the stock DIS, which I believe is Disney. And again, we see the same relationship, that when the signal is high, the stock weight is low, and vice versa. And again, we have for some other stocks here, HSY, this is Hershey Candy Bars, I believe. So again, a qualitatively very predictable company. When the signal is low, the stock weight is high. And interestingly, note that here, the signal is actually higher than it is over here, but the portfolio weight is much higher over here, and we would expect the opposite. But this has probably happened because there's internal competition between all of the stocks in the portfolio, because we limit the sum of all the weights to 1. So they compete with each other for the best position in the portfolio, and the optimization has found that in the period down here, some of the other stocks probably had a better return than this particular stock here. So they are given a higher position in the portfolio. But in this period here, this stock had a better return. And you want flexibility in your portfolio model, that it can handle this sort of thing. But on the other hand, you don't want it to overfit. So anyway, here we have the Johnson & Johnson stock. And again, it shows the same tendencies, that when the signal is low, we have a high stock weight. And when the signal is high, we have a low stock weight. So the portfolio model does what we want it to do, at least on the training set. And we can see here that it even allocates some of the portfolio to cash. And this was during the .com bubble, where it found that it was a good idea to have a part of the portfolio in cash and not even invested in the stock indices. So now let's try and plot it for the test set. So this is so-called out of sample data that the portfolio model hasn't seen during training. It still doesn't allocate anything to the S&P 500 and the S&P 600, but it does allocate something to the S&P 400. And if we just scroll down and look at the dates, we can see that the period is roughly between 2006 and 2017. And this period here, 2008 and 9, was the financial crisis, where there was a huge stock market crash in the United States and elsewhere. And we can see that on the signals for these stock indices, we have the price to sales ratio for the S&P 500. So that dropped dramatically around year 2009. And this means that the S&P 500 was cheaper according to this signal during this period. Conversely, because we're using the dividend yield for the S&P 400 and the 600, we see that this goes up dramatically around year 2009, so that again, these two indices were cheaper during this period. But interestingly, the portfolio model doesn't allocate a lot to the S&P 500 during this period, because the model says that some of the other stocks were probably better buys during this period of time. So it allocates maybe something like 40% of the portfolio to the S&P 400, but the rest of the portfolio is allocated to individual stocks. For example, the CLX stock here, we see that the price to sales ratio was very low during this period, so it allocates maybe something like 8% of the portfolio to that stock. And here we have for the DE stock, which had a very low price to sales ratio around year 2009 as well. So it allocates maybe something like 7% of the portfolio to this stock. Then when the signal increases again, the weight becomes low again. And this is exactly what we want to see. And the relationship is also very clear for this stock here, HSY. The signal becomes lower, so the stock weight becomes higher. And then when the signal becomes high again, the stock weight becomes low again. The relationship is not always so clear for the other stocks, and this might be because of the internal competition between the stocks, or it might be because the portfolio model maybe doesn't generalize so well to the test set. Although if we look at the stock K here, we see a clear relationship here, as we would expect, where the signal goes high and the stock weight goes low. And for Procter & Gamble, we see the same here. The signal goes up a little here and up a lot more here, and then the stock weight goes down here and here. And we see that the portfolio model only allocated a little of the portfolio to cash in the year 2017. Otherwise, it didn't allocate anything to cash at all. So this is kind of important, that it looks like the portfolio model does what we want it to do on the test set on out of sample data. So this is promising, and it suggests that we should do more research in this portfolio optimization model. And I encourage you to do that. I don't have data for that myself, and I don't want to spend like half a year to collect data manually by copying it from the financial reports. And I don't want to spend $10,000 on buying the data myself. And I think maybe if I worked on this portfolio model for another 3 or 6 months and I had proper data, maybe I could make it really good. And also if other people had ideas for other signals, that could probably work as well. But I have to work on other things. I'm not planning on working on this anymore. Again, the reason I am releasing these ideas is that I'm hoping that they can spread and become refined by a lot of people so that they can help stabilize the markets. So that we hopefully don't see any dramatic crashes where millions of people lose their jobs and, the whole economy suffers. So anyway, we also want to look at the actual returns of the portfolio and not just the weights. So we make a little helper function for comparing the returns of the different portfolios with the S&P 500 and other stocks if we like. For the training set, it looks like this. So this goes back to something like 1994 up to 2006 or something like that. And I sometimes wonder what colorblind people are gonna do when they look at these charts. And so I'm gonna explain to you what this shows. The bottom line here is blue, and this is for the S&P 500. The next line is green, and this is for the S&P 600. This is small cap stocks. The S&P 500 was for large cap stocks. Small cap stocks did a little better over the entire period, and mid cap stocks are S&P 400, and they did a little better still. And if we rebalance the portfolio every day using these 3 stock indices as well as the 9 individual stocks that we have, then we do a little better than all of these stock indices. However, we ignore trading costs and taxes. And I think if you took that into account as well, it would do a lot worse than even the S&P 500. But we ignore that for now. We just use it as a baseline to compare it with our more advanced portfolio models. So what we have here are the fixed weights. So remember that these are the same weights for every day that we rebalance the portfolio, but the actual weights have been optimized using the loop that I showed you in the flowchart above. And the brown line up here is our more advanced portfolio model using adaptive weights that map the predictive signals to stock weights. And we can see that on the training set or the in-sample data, this did quite well. Again, we are ignoring trading costs and taxes, but it is promising that this works, at least on the training set. So now let's look at the test set, or out of sample data, and this is for the period from about 2006 up to 2017. And again, at the bottom we have the S&P 500, and the S&P 400 and 600 did about the same, and the equal weighted portfolio did significantly better. The fixed weight portfolio did slightly better, and our adaptive portfolio did slightly better again. I should tell you that the optimization method is heuristic and it is stochastic. So if you run this again, you might get different results, but I run this many times and it looks basically like this. Sometimes these three are a little closer together, and sometimes there's not really a difference between the adaptive weights and the fixed and the equal weights, but usually it looks somewhat like this. So the adaptive weights are slightly better. I want to say a few things here. First off, you should use the technique that I showed you in the second video for proper comparison of the portfolio with the stock indices. So what we did in the second video, and if you haven't seen it, you really should watch it, is that we would compare all periods of, for example, 1 year duration and 2 year duration and 3 year up to 10 year durations. And we would compare all of them and the statistics for those. And that's a much better way to do it than just comparing from one date to another date, like from here up to here. Because what if you compare from this date here to, say, this date here? Maybe it looks different. Maybe the S&P 400 was better than our portfolio model. Now, the second thing I want to talk about is that, of course, in practice, you would not be running this portfolio model with just 10 stocks or so, because the trading costs would kill you. And if you have to pay taxes, that would kill you twice. But what this shows is that the portfolio model makes kind of sense. It allocates the portfolio like we want, but you need a lot more stocks. And ideally, you would also need to do a lot more research to find more signals. But what this method of portfolio allocation gives us is a way to learn automatically how to allocate the portfolio given some signals. So if you can find a lot of stocks and some good predictive signals, then it probably could work in practice. And it might even work for like intraday trading, like super fast trading, where you need to allocate your portfolio like 10 times per second or whatever. The method of optimization might also work for that. I don't think that you're gonna find short-term predictive signals that are as clear as the one we have here for 10-year annualized returns for some individual stocks and for the S&P 500 and the other stock indices. I think that when you consider short-term returns of either intraday returns or maybe a few days or maybe a month or even a year, I think the signals are gonna be a lot less clear, and that means you probably have to have a lot of diversification as well. But again, I think that the fundamental idea for doing the portfolio allocation using this method that I show you here might actually work as well. And who knows, maybe you can refine this to a point where you win a Nobel Prize instead of the obviously flawed method that Markowitz won the Nobel Prize for, and which they will teach you at even the very best universities in the world. So I wish you all the best of luck, and as usual, you can click on the link below this video to download all of this material.